Hey, this is Jussi. I run a small investment firm that specializes in REIT investing, and today I have some great news for you. The 10-year treasury has now dropped from over 5% at its peak about 1 year ago to less than 4% today, and I don't think that the market has yet fully realized how big of a deal this is for the REIT sector. The 10-year treasury is now trading at 3.9%, which tells you loud and clear that the market is expecting very significant rate cuts in the near term. Not just 1 or 2 25 basis point rate cuts, but much more than that, because the Fed's funds rate is today at 5.25%, and such a steep level of inversion just isn't sustainable. To put it simply, if the Fed funds rate was expected to stay at 5.25%, nobody would be buying the 10-year treasuries at the 3.9% yield level. The only reason why the 10-year yield is so much lower is because the market is so confident that interest rates will be cut very significantly in the near term, and investors want to lock in this yield for a long time to come. But don't take it just from me. According to the FedWatch tool, interest rates are now expected to be cut by 100 basis points this year alone and another 100 basis points by mid-2025. This is great news for real estate investment trusts, or REITs in short, because it means that interest rates are expected to be about 200 basis points lower in less than a year from now, and I think that this is the catalyst that will ultimately lead to the recovery of the REIT sector. And as these rate cuts now start to occur, there are a lot of REITs that could enjoy very significant appreciation because they remain very heavily discounted even right now, because the market has been in this wait and see mode, not trusting rate cuts before they actually implement it. But time is now running out, because the first rate cut is widely expected to take place on the 18th of September, which is in just 1 month from now, and this will change the whole narrative about REITs. Suddenly, investors will realize that the 5% yields that they were expecting from short-term treasuries and money market funds weren't sustainable after all. And as the expectations slowly change from 5% closer to 3% yields from money market funds and short-term treasuries, I expect a lot of these investors to come right back into the REIT market to capitalize on the much higher yields that REITs are today offering. Ultimately, the stock market is all about supply and demand. Over the past 2 years, REITs saw their share prices drop steadily because interest rates were rising and investors saw an opportunity to earn better income through fixed income investments, and this led to a lot of selling pressure in the REIT sector. This is very evident if you look at the chart that I'll put on the screen. You'll see there that there's been a very strong inverse correlation between REIT share prices and interest rates over the past 2 years, with every rate hike causing REIT share prices to drop further as more capital shifted away from REITs to fixed income investments. But I don't think that these investors will be any more loyal to fixed income investments, and as interest rates are now cut to lower levels, they will rush back to the REIT sector to capitalize on the higher yields, and I expect this to push REIT share prices to new all-time highs. And that's not just my opinion, it's also the opinion of Blackstone, which is the leading alternative asset manager in the world. Here's what they said on their most recent conference call. As a result of our conviction, we decided to adopt a more aggressive approach to new investments. I'm pleased to report that in the second quarter, we deployed $34 billion, the highest level in 2 years, and nearly $90 billion in the last 3 quarters since the 10-year treasury peaked. With inflation continuing to recede, we expect the Fed to begin cutting interest rates later this year, and this should be very positive for Blackstone's asset values. Here it's important to mention that Blackstone has been loading up on REITs this year. They first acquired Tricon Residential, which is a residential REIT-like entity that specializes in single-family homes. We used to also own it at High Yield Landlord, and we earned a very solid return on that investment. Then they also acquired Apartment Income REIT in a $10+ billion transaction, again paying a nice premium to the shareholders of the company, including myself and the members of High Yield Landlord. And now there are growing rumors that they're going after third REIT called Retail Opportunity Investments. It's been surging lately because of these rumors, but the point here is that Blackstone sees a lot of value in the REIT market, and they are now really stepping up their investments because they can sense that the window of opportunity is closing, with the Fed expected to start cutting interest rates in just a month from now. Hey, sorry to interrupt you for a second, but could you please do me a favor and click the like button? That will help me a lot to keep on growing. Thank you so much in advance. But what REITs are the best to buy today? That's not an easy question to answer, because it obviously depends on what you're looking for, your risk tolerance and so on. But if you're looking to maximize gains as interest rates are cut and capital flows back from fixed income to the REIT sector, you'll want to consider REITs that make good alternative for fixed income investors who are seeking higher yields. Therefore, these REITs would need to offer a high dividend yield that's sustainable and growing. An obvious example of that would be Realty Income, also known as O Stock. This is one of the most popular REITs in the world. Some people call it the monthly dividend company because it has been able to grow its dividend for about 30 years in a row. It pays a monthly dividend that's perfectly safe. They have an A-rated balance sheet, an amazing track record, growing their dividend even through the great financial crisis, the pandemic, the dot-com crash, and many other crises. And yet today it's offered at a 5.3% dividend yield, which is quite attractive and will only become more attractive as interest rates are cut in the coming years. And today a lot of investors don't see the value because they're able to earn a 5% yield on their money market funds. But as that yield now turns to, let's say, 3%, I think that a lot of these same people will certainly see a lot more value in the 5.3% yield of Realty Income, and this will lead to more buying pressure, investors bidding up its share price, and ultimately I wouldn't be surprised if it reprices at closer to a 4% yield level, which would still be a nice spread relative to the interest rates that we expect in about 1 year from now, and that would unlock about 25% upside. While you wait for this upside, you're earning a 5.3% dividend yield. The company is expected to keep growing its cash flow also by 3 to 5% per year. So just the growth and the yield alone, you're getting to roughly 10% annual total returns, and then you add about 25% of additional appreciation potential from multiple expansion, and therefore the risk to reward is quite attractive. But if you're willing to take a bit more risk, there are some even better options in my opinion. One of them would be WP Carry, which is also a net lease REIT, a peer of Realty Income, but it's more heavily discounted today and offers a higher dividend yield because investors are overlooking it. And I think it's in large part because of the recent spin-off of its office properties. The company decided to refocus on its best assets, so it sold some of its weaker assets and this forced it to cut the dividend. This has hurt its market sentiment, but ultimately now if you look at the future, the company is better positioned than ever because it now has just its best assets, mostly industrial properties. It has a strong BBB investment grade rating. It has a low dividend payout ratio of about 70%. It has strong rent escalations in its leases, and yet it's currently offered at a 6% plus dividend yield. If it repriced at a 4% dividend yield, just like Realty Income, that would lead to about 50% upside from here. And I don't think that's impossible because REITs that specialize in industrial properties tend to typically trade at even lower yield levels than that of closer to 2 to 3%. I think that WP Carry obviously deserves to trade at a higher yield than that because it doesn't enjoy the same growth prospects as REITs like Prologis, East Group Properties, and so on. But 4% is not impossible, and that could lead to 50% upside while you wait to earn a 6% dividend yield. Even if it doesn't reprice at a 4% yield level, and let's say it reprices at a 4.5% or a 5% yield level, you'll still enjoy good upside from here, and therefore I think that this is a compelling opportunity. But if you're willing to go even higher in the risk ladder, then you may want to consider EPR Properties, which is actually my favorite REIT of these three. It's also a net lease REIT, but it's today offered at an 8% dividend yield, just 9 times its cash flow. And it's so cheap because it focuses on experiential net lease properties like golf complexes, movie theaters, water parks, and so on. These properties are perceived to be more cyclical and riskier, but what the market I think appears to be overlooking is that this is a triple net lease REIT. It has over 10 years left on its leases, annual contractual rent escalations, the tenants are responsible for all property expenses, the rent coverage ratios are quite high at over 2 times typically, which leaves good margin of safety even if we go into a recession, and therefore I think that this is quite a stable business model, and I don't think that the cash flow will change materially in a recession. The payout ratio is historically low at about 70%, therefore I think that the 8% dividend yield is also sustainable and set to grow further in the coming years, and if interest rates now are cut significantly, I think that a lot of investors will see a lot more value in this 8% yield, and as investors bid up the share price, it's going to compress down closer to 5-6%, and this could lead to about 50% upside from here. But there are many more similar opportunities in the REIT sector today, and I expect them to richly reward investors over the next 12 to 24 months as interest rates return to lower levels. For my portfolio, I have cherry-picked what I believe to be the 20 best opportunities of the REIT market. And if you want to access my full portfolio, you can join High Yield Landlord, which is my REIT newsletter. For a 2-week free trial, I'll put a link to it in the description of this video. As I've said before, you won't be charged anything in the first 14 days. So if you want to just come and take a look at my portfolio to gain some inspiration and then cancel and do it on your own, that's perfectly fine with me. And otherwise, once more, if you could please click the like button, subscribe to the channel if you think that this was valuable. That will really help me a lot. Thanks so much, and see you at my next one. Bye-bye.